Hi, and welcome to another in the 10-minute tip series of recorded programs for credit and collection professionals. This one is titled Basics of Customer Financial Statement Analysis. My name is Michael Dennis. Let's go ahead and jump in. Before I offer this introduction, just a quick aside. I want to let you know that this program is part of a recorded series of programs available online and on demand through my sponsor, Wisconsin Credit Association. So if you're interested in listening to the complete program on this topic or any of the other programs in the on-demand library, please reach out to my sponsor, Wisconsin Credit Association. Okay, let's jump in with an introduction. So there are four main types of financial statements. There's balance sheets, income statements, statement of cash flows, and statement of shareholders' equity. Credit pros typically look at the first three: the balance sheet, the income statement, and the statement of cash flows. We do that when we can get that information from privately held customers, because companies that are not publicly traded do not have to share financial information with creditors, including us. On the other hand, publicly traded companies whose shares are sold on stock exchanges, have a legal duty and obligation to provide this type of information, and in fact getting financial statements from publicly traded companies is quite easy because typically it's available on the company website or on a variety of third-party websites. So one is difficult, privately held companies, and one is relatively easy to get, financial statements from publicly traded companies. The three financial statements that we used, as I mentioned, are the balance sheet, the income statement, and the statement of cash flows. The balance sheet shows what a company owns, it shows what a company owes, and it shows what's referred to as a residual, the equity. An income statement, also known as a profit and loss statement, identifies top-line sales revenues, the related expenses, and profits or losses. The statement of cash flow describes the sources and uses of cash by an organization over an accounting period, such as a calendar quarter or a fiscal year. So cash flow statements describe the exchange of money between the company and the outside world over that accounting period. On the balance sheet itself, we find conveniently labeled for us two categories of assets. They are current assets and non-current assets. Current assets are the assets that a company expects to convert into cash within 1 year. Like what? Well, inventory is a current asset because the company anticipates that it will convert inventory into cash within a year. How? By selling the inventory. Non-current assets are the assets that the company does not expect to convert into cash within 1 year. What would be an example of that? Well, if you were a warehouse, it would be a forklift. You would not expect to sell a forklift in the ordinary course of business. Why? Because you use it in connection with operating your warehouse. The balance sheet also identifies liabilities. Liabilities are classified as being either current liabilities or non-current liabilities. Current liabilities are debts, are obligations that a company expects to pay within the next 12 months, within the next year. In contrast, non-current liabilities are obligations due more than 1 year in the future. So an example of a current liability would be the accounts payable that a company has. We would expect that the customer would pay accounts payable within a year, perhaps even 30-day terms, whatever the standard terms are on those accounts payable. A non-current liability, that could be the lease payments that are owed on a piece of equipment that's been leased for the next 8 years. So clearly, not all of those payments come due in the next 12 months. So 7/8 of them would be long-term debts or non-current liabilities, and 1 year of them would be a current liability because the payment would be due in the next 12 months. And shareholders' equity is the amount that the owners have invested in the company when they purchased the stock of the company. Their initial investment is subject to adjustments for things like retained earnings, which represents profits that the company has made over the years that were not distributed to the stockholders, the shareholders, in the form of dividends. And of course, there are other adjustments to retained earnings. Perhaps the company has lost money and that would reduce retained earnings. And the third of the three financial statements is the cash flow statement, sometimes called the statement of cash flows. The cash flow statement reports about inflows and outflows of cash over an accounting period. Why is it important? Well, it's important because a company needs to have cash. It needs to have cash on hand to do things like pay expenses, pay us, pay creditors, and of course to purchase additional assets. Here's the key difference between an income statement and a statement of cash flows. Where an income statement tells us whether a customer has made a profit, a statement of cash flows tells us whether or not the customer has generated cash or has not generated cash during a specific accounting period. You should be aware that the cash flow statement is divided into three main parts. There are cash flows from operating activities, cash flows from investing activities, and cash flow from financing activities. There's also a bottom line on the statement of cash flows. The statement of cash flows will either report as a bottom line a net increase in cash and cash equivalents, or alternatively, a net decrease in cash and cash equivalents. And of course, a net increase in cash refers to an inflow of cash, and a net decrease in cash refers to a net outflow of cash. Credit pros also read notes. Publicly traded companies, when they send financial statements or we obtain them, come with notes to the financial statements. Perhaps the most important for the credit analyst is called the MD&A, Management's Discussion and Analysis of Financial Condition. This is management's opportunity to tell investors and potential investors and interested third parties, perhaps people like us, about their financial performance for the previous year. They'll talk about the good and the bad and the ugly of what happened in the prior fiscal year. In addition, the MD&A will describe trends and risks that have affected performance in the past and could potentially affect or harm the customer's financial condition, financial health, and financial performance in the future. And for that reason, understanding and reading the MD&A is pretty important. If you've been in and around the credit department for any length of time, you've probably heard people talk about financial ratios. So what are they? Well, financial ratios are things that creditors use to make it easier to make credit decisions. Decisions about what? Well, about things like, should we extend credit to this applicant company? Should we continue to extend credit to this customer? Should we approve a higher credit limit for this customer? How high should the credit limit go? In connection with the credit applicant, what credit limit should we assign to the applicant company? These are the kinds of questions that financial ratios help credit decision makers to make. We, credit pros, calculate financial ratios using financial statements provided by customers to us. As a general rule, desirable ratios don't seem to follow any simple pattern. From our perspective as creditors, they tend to vary by industry. There are 4 different classes or types of financial ratios that credit professionals use. Those types are ratios evaluating leverage, liquidity, profitability, and efficiency. I'm going to provide an illustration of one from each group. The first one is the current ratio. It's a liquidity ratio. Liquidity refers to an assessment of the idea that the customer is likely to have cash on hand to pay invoices as they come due. The current ratio, as a liquidity ratio, is calculated to see how easily a customer can pay its current liabilities by converting its current assets into cash. The formula we use is current assets divided by current liabilities equals the current ratio. A second type of financial ratio is a financial leverage ratio. The debt-to-equity ratio is a very popular leverage ratio. It measures the amount of debt a customer carries when compared to the amount of equity has been invested in the company. Fundamentally, the DE ratio is used to determine how much of a customer's assets are financed by debt rather than by equity. And the formula for the debt-to-equity ratio is total debt, aka total liabilities, divided by shareholders' equity. The total debt and the shareholders' equity summaries are both found on the balance sheet. It's readily available information. If you have a customer's balance sheet, you have those two numbers that have been calculated for you on the balance sheet. A third type of financial ratio is a profitability ratio. The net profit margin is an example of a profitability ratio. The net profit margin presents information about the net effect of all the company's activities on its ability to generate a net profit. The formula used is net income divided by sales. So this is on the income statement. You will find net income is the bottom line, and sales refers to net sales as the top line. So what you're doing is you're taking the bottom line number, dividing it by the top line number, turning that into a percent, and that is your net profit margin. Here's an easy example. Assume that you find net income on the income statement of $714,000, sales of $11.555 million, and you do the calculation, 714 divided by 11,555. On your calculator, it's 0.061, and as a percent, that's 6.1% return on sales. The fourth type of ratio is called an efficiency ratio. Efficiency ratio refers to management's efficiency in utilizing the assets of the company to generate sales and profits. One of the most commonly calculated efficiency ratios is the receivables turnover ratio. It's calculated by dividing sales by average accounts receivable. The formula is sales divided by average AR. And from our perspective, as it relates to the turnover ratio and all of the other turnover ratios we calculate, the higher the ratio, the better. And if you think about profitability from our perspective, the higher the ratio, the better. When you think about liquidity, well, the more liquid, the higher the ratio, the better. And the only one that is counter is financial leverage. From our perspective, debt being held by the customer is bad if it gets to be too large. So in that scenario, the lower the leverage ratio, the better. Thanks for sticking with me. I'm sorry I ran long. It's a lot of information to try and cover in 10 minutes. I appreciate your time and attention. I hope you found the program to be interesting and useful. Again, if you're interested in hearing the entire 30-minute on-demand program on this topic, please contact my sponsor, the Wisconsin Credit Association. Thanks. Bye-bye.